coming to partnerships, so far when we did, okay, when we look at these different entities, whether it is an S corp or it's a partnership, you know, these all have something in common, right? They're all pass-through entities, which means that you know, they do not pay any income tax at the entity level. It is paid by the shareholders or the partners depending on their proportionate share of interest. So a partnership also works kind of the same way like the S corp we did. The formation of a partnership, unlike an S corp or a C corp where you need a formal articles of incorporation, there is no such requirement for a partnership, though you can register the partnership. It generally is an informal creation. Now, if you want to recall from the beginning of the class, first class that we did, you know, we went through different types of partnerships. We said there is general, limited partnership, limited liability partnership, and limited liability company as well. So all of these, you know, general partnership, if you remember, this is where, you know, all partners are general partners, which means they have unlimited liability. Limited partnership is where, you know, there is at least one general partner and maybe many limited partners, which means that their liability is limited. Limited liability partnership is where all partners in the partnership have limited liability, and generally LLPs are formed by you know, attorneys or CPA firms or dentists, where they don't want to be held liable for the other partner's acts. Then we have limited liability company, which has the features of both a corporation as well as a partnership. It's limited liability. It's for all partners. It can function as a C corp or as a partnership, but it has a limited life. When we do Reg 6 or we do Reg 6, you know, you can learn more about these partnerships. But I just want to introduce here a little bit so that you understand how liability plays a role, you know, in determining the different types of partnerships. Formation, non-taxable, similar to that of C corporations, though in C corporations we call it a, you know, Section 351 transaction. There's no such tag over here, but then you know, you know, the formation is through a transfer of cash and property, where the property is at carryover basis and holding period. And a partner can also join a partnership by contributing services. And services, when somebody contributes services in return for partnership interest, is generally taxed at the fair market value to the partner. Now, if you look at the partnership income tax return, it's as such, you know, on a form 1065. Again, it's only an information return, right? The partnership does not pay any taxes. Income is passed through to the partners via Schedule K1. And how does this happen? There were some arrows here which have gone missing, but generally, so you start with form 1065 page 1, where the ordinary business income and deductions are reported, and then that's carried forward. And I'll also show this to you on the form on Schedule K, where, you know, you have a summary of the net business income, and then you have the separately stated items that affect individual partners. And when we did S corp, we talked about what these separately stated items would be. They would be interest, dividends, capital gains and losses, rental income, Section 179 depreciation, tax exempt interest income. All of these are separately stated charitable contributions. These are all separately stated items because the treatment of each of these items depends upon the individual's tax situation. Like a very common example that we can use here is the capital loss treatment, right? Capital loss, you can take up to capital gains on the individual tax returns, and anything in excess of that you can take up to a max of $3,000. But whether each partner will be able to fully absorb the capital loss or take only the $3,000 depends upon the individual taxpayer's situation. Therefore, they're all separately stated. So you can see the transition from 1065 to Schedule K, which has the, you know, the summary of the net income or loss. Then followed by that, you have also include some items that affect the partner's basis, like for example, any withdrawals by the partner that's reported on Schedule K. And then all of this information flows through to Schedule K1 based on the percentage of partnership interest. Each partner gets one Schedule K1, and using that K1, they will file their individual income tax return. So to get an understanding of this, I'm going to open up the book where you can see the Form 1065. Okay. So as you can see, this is the first page of Form 1065. It is an information return where you have all the general partnership information that's going here, whether it's initial return or if there is what is the name of the partnership, the principal business it is in, and the address. The first page typically, again, I know it includes your income and your ordinary business deductions. Guaranteed payments underlined here in red is something that I'm going to discuss now. So this is your ordinary business income or loss. The second page is more about information in terms of to the IRS in terms of what type of entity is it. It is. So look at this. What we discussed: general, limited liability, or limited liability partnership, or even a foreign partnership. You will have to let the IRS know what type are you, right? And plus other information in terms of who are the partners and what is the percentage of ownership. All of this goes into the second page. Schedule B, further continuing, more information, compliance information for the IRS. Then your Schedule K, right? So this is here, it carries forward your ordinary business income or loss from page 1, and then it has all these separately stated items, as you can see. Your interest, dividends, royalties, capital gain, capital losses, section 179, contributions, these are all basically even your credits. These are all separately stated items, even your alternate minimum tax, and items affecting the partner's basis, such as distributions or, tax exempt income. So coming from there, this is your Schedule K1. I mean, when we did S Corps, we also saw that the shareholders there had a Schedule K1. The Schedule K1 here, again, is separate for each partner, where you have the partner's share of information here, followed by, what type of an entity is it? What is the partner's percentage of profit and profit loss sharing? The beginning and the ending percentage, his capital account, and all of the income that's getting allocated to him, the ordinary income as well as the separately stated items. So this is basically, the flow through of income for a partnership. Any questions till now? Jitendra, you were asking if we can download these materials. I'm pretty much just summarizing what is there in the book. If you're unable to follow the book, then let us know how we can help you out, okay? So now there are some special items as far as partnership is concerned. One very unique item to partnerships is guaranteed payments. And we talked about it a little bit when we did Reg 1, where we said, when we were studying about sole proprietorships, and we were talking about what are the types of income that is subject to self-employment tax. And one of those were guaranteed payments, where we said, guaranteed payments are subject to self-employment tax. So now, What are these guaranteed payments? These are payments made to partners irrespective of the partnership income. That is, irrespective of whether the partnership has a positive ordinary income or an ordinary loss. The the partners, I mean, the partnership is supposed to pay the partner. Now, this can be in the form of a salary, it can be in the form of fringe benefits, or it can be in the form of interest on partner's capital. But they are all guaranteed payments that are given to the partner irrespective of the partnership income. Now, where all does this go on the tax return? It goes as an ordinary business deduction for the partnership. So we talked about ordinary business deduction. Remember, when we looked at the form 1065 in the first page, let me just go back to the form. So you see here, guaranteed payments to partners is an ordinary business deduction to the partnership. It is also a separately stated item, and we'll show that here. Oh, see, if you can see here, guaranteed payments is a separately stated item. And why is it that? Because it is not applicable to all partners, right? Not all partners are receiving guaranteed payments, only a few. So therefore, it is an ordinary income deduction to the partnership, and it is also a separately stated item because it does not affect all the partners. And where does the partner record that on his tax return? Again, it's income subject to self-employment tax, so it would go on his Schedule E, but additionally, it would also be subject to self-employment tax. So guaranteed payments is a very important concept as far as, partnerships is concerned, and you want to know that it has got this dual treatment, recording as an ordinary business deduction as well as a separately stated item. Now, transactions between a partner and the partnership, generally considered as transactions between two different entities, except when the partner with whom the partnership is transacting is a 50% or greater partner. So, in such cases, the losses, if there is a loss involved in the transaction, that is disallowed and gains are ordinary income. Okay, so if there is a more than 50% partner, remember, there's a disadvantage when there's a transaction. Basically, it's treated as a related party transaction where the losses are disallowed and the gains become ordinary income. A deduction of organizational and business startup costs, same rules as what we had for corporations. There's a separate $5,000 organizational cost that's allowed and a separate business startup, $5,000 business startup cost that is allowed. Filing requirements for partnerships. Partnership tax return is generally a calendar year tax return. That is, usually they use the majority partners tax year, or everybody is a calendar year. It is all partners tax return. Or they use a calendar year. Now, supposing the partnership chooses to file a fiscal year tax return. And what they want you to do is, they don't want the partnership to defer income beyond a 3-month time period. So there's an example in the book which I want you guys to look at in terms of what this means. Okay, so here, look at this example on page number 20, I believe. It says a partnership that is normally required to use a 12/31 calendar year can, with a valid business reason, choose 11/30, 10/31, or 9/30. The result is to make it possible for up to 3 months of partnership income to be deferred into the following year before being taxed on the return of the partners, which is basically a Section 444 election. Now, what it simply means is that generally follow a calendar year, but if you want to choose a fiscal year, then you must not defer for more than 3 months from the calendar year, which is the 12/31. Okay, because the taxation is at the individual partner level, they don't want the partner to defer his income recognition by more than 3 months. So even if you're choosing a fiscal month, just remember that it should either be 11/30, 10/31, or 9/31, but not beyond that. Okay. Due date of Form 1065 calendar year tax return, it is a 315 plus a 6 months extension, which is basically September 15th. If it's a fiscal year, then it is 2.5 months from the close of the year end. Again, I think I've mentioned this before. Due dates are not tested anymore. And so, you don't need to really remember this, but good to know kind of information. Now, again, when we did S corporation, something that I mentioned, whether it is partnerships or S corps, even C corp, right? For that matter, basis is a concept that's very important and tested across all the different types of entities. And there is a chance that you can get confused in the basis treatments. So, the more the questions you work out on this, the better the clarity. We'll also do questions on partnerships, but understand that this is a very important concept. So, partners basis, how is it calculated? Similar to what we've seen for S corporation shareholders. The initial basis consists of cash or contribution of property or services, plus say other contributions that you make during the year, plus any separately and non-separately stated items, less distributions, less percentage of non-deductible expenses, less percentage of losses and deductions, and then you arrive at net basis. Now, always remember, guys, when the distributions can never reduce a partner's basis below 0. And also, say, the partnership is incurring a loss, right? So you'll have to account for the distributions first when you're computing the partner's basis before accounting for the loss. Okay, because distributions is something that the partner has actually received, and therefore that will reduce his basis, but he may not be able to use the entire amount of loss. So when we do questions, again, you'll understand this. Now, partner's basis refers to the amount the partner has at risk in the partnership. Now, why are we concerned about what is at risk to the partner? Because again, when we talk about losses, the deduction of losses will be limited if you don't have enough basis. So at the individual level, it is very important to determine whether the partner is at risk to the partnership. And what is the at risk amount? It includes the partner's capital and the partner's share of partnership liabilities. So if you have losses beyond this, then it will generally have to be carried forward and utilized until you have other passive income to absorb this. Remember, guys, partnership income is passive income. Likewise, even an S corp shareholder, these are all passive activities. So you can only take your losses to the extent of your income or to the extent of at risk. Anything beyond this, you will have to carry forward and utilize only when you have other passive income to offset this. Now, when we make contributions, okay, so how is your basis formed? When you contribute cash, cash is your basis in the partnership. When you contribute services, it is the fair market value of the services that forms your basis in the partnership, but the partner will also have to report ordinary income for the compensation received. When you're contributing property, it is basically the carryover basis of the property, which becomes your basis in the partnership. But say you contribute property with liability. Now, what happens here? The partner's basis in the partnership is the carryover basis of the property minus the liabilities assumed by the partnership plus percentage of partnership liability. Now, how is this different from C corp or S corp? Let me see if any of you guys are able to answer this. How is partners, basis calculation different from an S corp or a C corp? What is it that's different or sets apart the calculation of partners' basis? Anybody wants to take a Do you get this?
Here we do not consider that 80% of the cash and property contribution.
Okay, so that is when your initial formation, we look at all partners and we see that whether it's a taxable transaction or not. But when we are talking about the individual partners basis, right, the calculation where I said the partners basis is the carryover basis of property minus the liabilities assumed by the partnership plus percentage of partnership liability. So how is this calculation different from, say, an S Corp shareholders basis? Does anybody know the answer to this? Shareholders percentage. Okay, so Sushma, you've typed here, you said shareholders percentage liability is not considered. Yes, absolutely, right? So when we did an S corporation shareholders basis, we did not, if say somebody, or a C corp shareholders basis for that matter, we the shareholder contributes property with liability, so he gets the carryover basis of the property and the liability is assumed by the corporation, but it ends over there. Here, the partners also get basis for a percentage of the partnership liability. And that is what sets apart a partnership basis, a partner's basis in a partnership from that of an S Corp shareholders basis. Their S Corp shareholder, they don't get a percentage of the, the corporation's liability, whereas a partner gets a percentage share of partnership liability. Because why? We're assuming these are all general partners who have unlimited liability, which means whatever is the partnership's liability, they are also liable for that. So that's why they get a percentage of the partnership liability. And we can quickly look at an example in the book for this. So look at this. Assume that ABC partnership is formed with three equal partners, Alex, Bill, and Kathy. Alex and Bill each contribute $100 of cash. Kathy contributes land with tax basis of $90 and fair market value $130, subject to an unpaid mortgage of $30 that's being assumed by the partnership. In terms of fair value, each partner has to contribute an equal $100, but the tax determination basis is as follows. So initially, each one is contributing $100. So A is contributing $100 of cash, and therefore, that would be his basis. Now, B is also contributing $100 of cash, and therefore that would be basis. Now, let's look at C, Kathy, who's contributing land with a tax basis of $90, and she is contributing a mortgage of $30. So that mortgage that she's contributing gets reduced from her basis. But each partner, including Kathy, will get a percentage of the partnership liability. So this $30 is now spread among all the partners, and $10 gets added to each of their bases. So the net basis at the end of the day for A, it is $100 cash contribution plus percentage of partnership liability, which is $10, 110. Likewise for B, and for C, it's $90, the carryover basis of the property, less the liabilities contributed, which is $30, plus a share of partnership liability 10, resulting in a total basis of $70. Okay, so remember, guys, this is unique for partnerships, not for the other types of corporations, S corp or C corp. Now, partners' basis can never be reduced below zero. In partnership, again, a unique thing that you want to know is this terminology: outside basis versus inside basis. Outside basis, basically, we're talking about the partner's basis in the partnership. Inside basis is what the partnership has in the assets of the partnership. So whenever we talk about outside basis, remember we're talking about the partner's basis. When we talk about the inside basis, we're talking about what the partnership has as basis in the assets of the partnerships. Now, also you want to know what is the difference between the capital account and partners basis. Your capital account is basically your book capital, whereas the partners basis, it's the capital plus the percentage of partnership liabilities. Now, unlike S corp, the partners also receive distributions, and the distributions can be of two types: non-liquidating and liquidating. What is a non-liquidating distribution? Basically, a regular distribution during the life of the partnership. How does that treat it? It reduces the outside basis of the partner or the partner's basis by the amount of distribution received. Say there is a mix of distribution, cash and property, then you always account for cash distributions followed by property. Remember, cash distributions can reduce a partner's basis below zero, but a property distribution cannot reduce a partner's basis below zero. Now, if there are excess cash contributions, the partner will recognize a gain. If the cash distribution, say, is less than partner's basis, the partner recognizes a loss, but not here. This is only for actually liquidating distribution. But in a non-liquidating distribution scenario, if the partner receives cash in excess of his basis, then he would recognize a gain. Now, property distribution, as I said, here, it cannot reduce the partner's basis below zero, and the distribution is always on the inside basis or the tax basis of the partnership. That is, for example, say, the tax basis of a land in the books or in the partner, for tax purposes is $100, whereas the fair market value is $150. But when you're distributing to the partner, you will always distribute it at $100 and not at $150. So that's what I mean here by property is distributed on tax basis and fair market value is ignored. But we have to make sure that the property being distributed, its basis cannot be more than the outside basis of the partner. So again, the same example, if the property has a basis of $100, but the partner's outside basis is only $90, I cannot distribute that the property at $100 to the partner and have him incur a gain of $10. Basically, distribution of property can never result in any recognition of gain or loss, nor can it reduce the partner's basis below zero. So then what do I do in that case, right? So it says if the property distributed has a higher basis than that of the partner, then adjust the property basis downwards such that the basis is not reduced below zero. So in the same example that I was giving, $90 is the partner's basis, $100 is the tax basis of the property being distributed. So what I have to do is I have to make a downward adjustment, reduce that $100 to a $90, and then and then distribute it to the partner such that the partner's basis is reduced to zero. Again, this is only a tax basis adjustment, guys. These adjustments don't reflect in the books. But for tax purposes, it's important to understand that distribution of property should not result in a gain or loss recognition. And therefore, we make this, basis adjustments. Okay, hope everybody is clear because this is an important concept. Yeah, maybe some hands can be raised if you guys have understood this, or if not, you can, you're welcome to unmute and speak. Okay, Nidhi got it, Shelly got it, great. Okay. Moving on, liquidating distribution. So what do you mean by liquidating? It happens when the partner withdraws from the partnership, or there's a retirement, or there's a death of the partner. Here too, you account for cash distributions first, followed by the property distributions. Again, property can never reduce your basis below zero. Here, excess cash distributions, partner recognizes gain if partners' cash distributions are less than the partner's basis, then he would recognize loss. And loss recognition you will recognize because it's liquidating. You are ending your relationship with that particular partnership. So, there is no more distributions or no more transactions. So, if there is only a cash distribution, then there is a gain or a loss to recognize. But if there is a property distribution, again similar to non-liquidate, it cannot result in a gain or loss situation, and it cannot reduce the partner's basis below zero. Then what do we do? If the basis of the property is greater than the partner's outside basis, then you adjust the property basis downwards and then reduce the partner's basis to zero. If the basis of the property being distributed is lower than the partner's outside basis, then you adjust the property basis upwards such that you're again making sure that the partner's basis is zeroed out. So the same example that I talked about, if we reverse it, right? Now let's assume that the property being distributed was $90 and the partner's outside basis is $100, and this is a liquidating distribution scenario. So then what do we do? This partner is not going to be with us anymore. We need to zero him out, right? So what we'll do is we will adjust the tax basis upwards. So instead of 90, we'll say we're distributing property with a tax basis of $100 to this partner and make his basis basically zero. Okay, so remember guys, partners distribution of property never can result in a gain or loss recognition. Sale of partnership interest. Now, so far we talked about liquidating and non-liquidating distributions, and now we also look at now the partnership itself is not going to be there, this I'm sorry, we're going to look at the sale of a partner's interest. A partnership not going to be there as a determination, but we're going to look at sale of partnership interest. So what happens here? Say a partner sells his partnership interest to another partner. Instead of a withdrawal or a retirement, we're having a sale. So what happens? What is this amount realized? Is the amount realized is the cash plus fair market value of any property that you receive plus relief of debt. Right? Why is relief of debt included here? Because as partners, we are also liable for the partnership liability, right? So your amount realized, that is, say I am selling my partnership interest to Priyanka here on the group, right? So she is, in turn, she is giving me cash, she is giving me fair market value of property, plus she's also going to take over my debt that I have in the partnership. So that would become part of my amount realized. Now, my gain realized would be a capital gain because, a partnership is treated as an investment. Now, so your recognized gain is again ordinary gain to the extent of any inventory or receivables received, which is a hot asset. Let me just go through the example in the book quickly to understand this. Okay. Okay, so assume that Annie and Ang are equal partners in the Annie-Ang partnership, and then the partnership, which reports on a cash basis for income tax purposes, has the following items. So we have a tax basis, and then we have a fair market value for each of these items, and then we have the liabilities. Now, Joy purchases Ang's 50% interest in the partnership, paying Ang $375 in cash based on the fair market value of the partnership, and assuming Ang's share of partnership liability. So now, what is it that Ang is realizing? She's getting a cash of $375, and Joy is assuming her share of liability. What is her share of liability? $50. So you can see this was Annie and Ang's equal partnership, right? So the liabilities on the book were $100. So she gets 50% of that, 50. So total amount realized is $425 less the partner's basis, right? That is what your tax basis to determine your gain or loss. What is the partner's basis? Her capital is $25 plus her share of partnership liability, which is basically $50. So that is the partner's basis. When you subtract that, her gain or loss of $350 is actually a capital gain. But supposing, this gain also include some items which are hot assets, such as inventory or receivables. Because and why are they called hot assets? Because normally when you sell them in the ordinary course of business, they don't result in any capital gain or loss recognition. They result in ordinary income or loss recognition. So therefore, to the extent of these hot assets, your gain will have to be recognized as an ordinary gain, and the remaining can be capital gain. Okay, guys. And finally, the termination. So now the partnership is not going to exist. So what do? You need to file a final return. There are several reasons why the partnership could terminate. The partners basically elect to terminate, or the business is discontinued, or there's only one partner remaining. Or another interesting thing is that more than 50% of the partnership interest has changed hands during a 12-month period. So then that would also cause a termination of the partnership. There are different other things where it says if the business continues, you create a new PTIN, which is basically partnership tax identification number. You file a new tax return and treat as contribution of assets from the old partnership to the new partnership. Because if the existing partnership discontinues, but a new partnership is formed in its place, then you simply treat it as if the assets have been contributed from the old to the new. Now, if the existing partnership divides into two or more separate partnerships, then what do? The partnership which has the majority of the old interest continues as the old partnership. The remaining would be treated as a new partnership, and they would file a new tax return. But if say there is no majority in the new partnerships that have formed, they don't have any majority, then they're all treated as new partnerships, and the old partnership is dissolved. If two or more partnerships merge, right, then similarly, if there is a majority interest of the old partnership, then it will continue as the old partnership. But if there is no majority interest, then a new partnership emerges, and then the old partnership is considered to be dissolved. So guys, so this kind of completes our partnership part. And I want to know if you have any questions. We'll do the questions at the back of the book. While doing that, also we can address your doubts that you may have. Let me go to the So guys, you can unmute yourself while we do these questions. Okay, and let's see how much of it you've got it. A partnership inception. At partnership inception, Black acquires 50% interest in Decorative Partnership by contributing property with an adjusted basis of $250,000. Black recognizes a gain if the fair market value of the contributed property exceeds its adjusted basis. The property is encumbered by a mortgage with a balance of $100,000. Does Black recognize gain in these two scenarios? What's the answer here? Does Black recognize gain? Is it a taxable transaction for Black? Guys, can unmute yourself and speak. Priyanka, I've unmuted you. What is the scenario here? Is this a taxable transaction or not? He's acquiring 50% interest, contributing a property with a basis of $250,000. And if the property had a mortgage of $100,000, would there be a taxable transaction? Avni, Deepika, Kate Key, anybody has answers?
I don't think it's a tax. I think it's a tax-free transfer because any cash or property contributed is a tax-free exchange.
Right, right. And does the fair market value of the property matter here?
It need to be reduced to basis.
Fair market value thing needs to be reduced.
Yes. So answer is D.
Reduced from where? I didn't get you here.
As I said, you need to reduce fair market value to basis of partnership. Means partners basis.
Why would we do that?
For if you transfer property, then it could not result gain or loss to partner.
It won't. See, I think you're partly right. I mean, transfer of property does not result in gain or loss, but then the fair market value is something that we ignore. We don't reduce the basis by the fair market value. It does not play any role in partnership, taxation. It does play some role when we are talking about an S corp or a C corp. When say the basis of the property you're contributing is more than fair market value, then it may affect, but here the fair market value has no role to play. So yeah, the correct answer here is D, neither 1 nor 2. It does not matter if the fair market value of the property is greater than its basis. The property that is encumbered by the mortgage has a balance of $100,000. It's definitely lower than the adjusted basis, and therefore there is no gain or loss to recognize. But what happens, say, if the mortgage balance is higher than the adjusted basis of the property being contributed? What would we do at that point of time? Who has an answer for that?
We'll reduce the adjusted basis then.
Yeah, so basically the partner will have to recognize the gain, right? Because he's contributing excess. He's benefiting by contributing more mortgage. The partnership is going to take over your liability. So you will have to recognize a gain, but you cannot, which basically make your basis a 0. You will not have any basis at the beginning of the scenario because you're contributing excess mortgage. And that will be offset by the amount of gain that you're recognizing. Okay. Next question. In computing the ordinary income of a partnership, a deduction is allowed for contribution to recognized charities, the first $100 of dividend received from qualified domestic corporations, short-term capital losses, and guaranteed payments to the partners. So which one of these is an ordinary as a deduction to the partnership?
The guaranteed payments to partners.
Yes, exactly. Yeah, because all of the other items are guaranteed payment is also a separately stated item, but all of the others are not are not ordinary income deduction. They are only a separately stated item, whereas a guaranteed payment has a dual role, right? It's also an ordinary income deduction and it is a separately stated item. So therefore option D is the correct answer. Let's look at one more question here, and then I want us to do the simulation that is there at the back. Let's look at this. Number 10. The partnership of Martin and Clark sustained an ordinary loss of $84,000 in 2013. The partnership as well as the two partners are on a calendar year basis. The partners share profit and losses equally. At December 31st, 2013, Clark, who materially participates in the partnership's business, had an adjusted basis of $36,000 for his partnership interest before consideration of the 2013 loss. On his individual income tax return for 2013, Clark should deduct how much? So how do we do this? So first of all, when we're talking about deduction of losses, we need to figure out if we have enough basis, right? We can deduct losses only to the extent of our basis. If we don't have enough basis, then they probably get, they get postponed, right? The deduction gets carried forward to the future years. So how is that calculated? What is Clark's basis here?
36,000.
$36,000. Okay. Now, just give me 1 second, guys. What Clark's basis here is question 10. Clark's basis. This is $36,000. Did he have any distributions during the year? Remember, I said that before accounting for losses, we'll have to see if there are any distributions. There are no distributions, right? That's zero. Now, the total losses are $84,000. What is Clark's share?
42.
42, yes. So that's 86,000 divided by 2. So it is $42,000, right? Now, can he take, so 84 divided by 2, can he take the entire $42,000 as loss?
No.
How much is allowed?
36,000.
36,000, only up to the basis, right?
Right, right.
Yeah. Anything beyond that must be
Carry forward.
carried forward. Yeah. And this loss is an ordinary loss for him. It's not a capital loss, right? It's not a capital loss because he is not liquidating his interest. I mean, if it is a liquidation of interest, then you would have capital loss and gains coming into picture. But this is an ordinary business loss that's being distributed, right? So your correct answer is option A.
Right.
Let's do one more question here, actually. Question 11. Okay, Chris, a 25% partner in Vista Partnership, received a $20,000 guaranteed payment in 2013 for deductible services rendered to the partnership. Guaranteed payments were not made to any other partner. Vista's 2013 partnership income consisted of net business income before guaranteed payments of $80,000, net long-term capital gains of $10,000. What amount of income should Chris report from Vista Partnership on her 2013 tax return? So now Chris is a 25% partner, right? And she's also receiving guaranteed payments. So we need to find out what is it that she needs to report as income. So what is it? So how do we determine her income? What is the business income? Business income is $80,000.
Minus
Should
20.
we minus 20 exactly? So we need to subtract the guaranteed payments for that, because to arrive at your the net business income, guaranteed payments is an ordinary business deduction, right? So we will need to subtract $20,000 from there. So the business income that gets allocated is 25% of $60,000, right? Because she's a 25% owner. Then what else gets allocated to her? The net long-term capital gain.
Yeah.
How much was that? 10,000. So 25% of that.
Yeah.
2,500. What else does she get?
Guaranteed payment.
Guaranteed payments, right? She gets 100% of the guaranteed payment.
Yes.
Because it's only distributed to her, right?
Right.
So what's her total income? $37,500 is her total income. Yeah, so guaranteed payments is an important concept, guys, and here it's very important to first identify, does your business income include the guaranteed payments? Very often the language is confusing in the exams. You have to carefully check to see if a guaranteed payments has been accounted for or not. Let's go to this simulation that's here. It's on your page number 73. Okay. So during 2013, Adams, a general contractor, Brinks, an architect, and Carson, an interior decorator, formed the Dex Home Improvement General Partnership by contributing the assets below. So Adams gives cash, Brinks gives land, which had a basis of $12,000 and fair market value of $21,000, and Carson gives inventory, which is $24,000. The land was a capital asset to Brink, subject to a $5,000 mortgage, which was assumed by the partnership. So for items 1 and 2, determine and select the initial basis of the partner's interest in Dex. So what is Brink's initial basis?
12,000.
Pardon me?
8,000.
8,000. So how do you arrive at the 8,000 number?
Basically, the land that Brinks has gotten, it has a mortgage of $5,000. So we'll
Right.
reduce it from Brinks' adjusted basis of 12,000 and allocate it between all the three partners in the profit sharing ratio, which is 50:20:30.
Okay.
So Brinks' share will be 12,000 minus 5,000 plus 1,000. That comes to 8,000.
12,000 is the basis in land, right?
Minus 5,000, which is the mortgage that he is contributing.
Yes.
And then add back the percentage of share in the partnership liability.
Yes, which is basically he has 20%, right?
Yeah, so 20% of 5,000 is
$1,000. So his total basis here is $8,000. Is everybody following this?
Yes.
Yeah. I just need to see some hands raised, even if you're not talking. Okay, great. Then let's look at Carson. What is Carson's story? Carson is giving us inventory, right? Inventory Again, he would get a basis of $24,000 plus, as pointed out, 30% of the partnership liability, right? So which is basically 5,000 times 30%, 1,500 he would get. So Carson's total basis. People are able to see my screen, right? So now, in your book, if you follow the order of the book, after partnerships, I think we have starting with estates and trusts. Estates, trust, and gifts is the overall heading, but we'll follow slightly jumbled order where we'll do gift tax returns first, followed by estates, and then finally trusts. And why is it that, right? So far we're doing all tax returns that are done during the lifetime of the taxpayer, whether it is an individual or a business tax return. A gift tax return is also something that's filed during the lifetime of the taxpayer for gifts given. Remember, the recipient of the gift has no tax liability, but the payer of the gift may be subject to tax liability. Now, generally, the gift tax liability is unified with the estate tax liability. And why is it that? As people who have large estates, or basically who are typically very, very wealthy, they may try to give away gifts their lifetime so that upon their death, the estate will not have to incur such a large tax liability. And again, just to give you a little bit of preview, the estate tax liability is computed on the fair market value of the assets that are there in the estate. So, so obviously, the fair market value is higher than a large estate tax is anticipated to be paid. So, as a tax planning, a lot of guys will try to give away gifts during their lifetime, and and ensure that they leave a much smaller estate when they die, so the estate tax liability is lower. But the government is obviously much more smarter, and therefore they figured out that, okay, hey, let's unify the gift and the estate, and they will have a unified tax rate, and we'll see what that exactly means. So, but what is it that gifts that are taxed to you? The gifts that are taxed to you are basically, any gift that you give, which is the cash or the fair market value of the property that you are giving, and also irrevocable transfers. So what do we mean by irrevocable transfer? So basically, say I gift an apartment to somebody, and it's an irrevocable transfer if I say that, hey, you keep that with you, I don't need it ever. But then say I tell them, okay, you can keep this apartment for 2 years, but then the 3rd year I need it back to, you have to give it back to me. So that is a revocable transfer. It's not irrevocable. So all irrevocable transfers would become gross gifts. And also the gifts are generally classified into 3 types: present interest, future interest, and uncompleted interest. Let me go to the book to explain that. Okay, so what is a gift of present interest? Basically, a gift is of present interest if the recipient is able to enjoy its benefits immediately. I gift a car to somebody, the car is for immediate enjoyment of that person. So that is a gift of present interest. And when there is a gift of present interest, the tax rules allow the taxpayer to take an exclusion of up to $14,000 of a gift made to a person, each person. So if I give a gift of present interest to Mr. X of say a vehicle, and it's available for immediate use, then I can immediately reduce $14,000 from my gift. If I am doing a gift split with my spouse, that is, both of us are considering as if we have given the gift, then it would be a $28,000. That is, each one of us would get a $14,000 exclusion. Now, if I give a gift of future interest, again, so the gift of present interest, gift of future interest, they're all irrevocable, right? Once it's given, I cannot take it back. A gift of future interest is when it is not available for immediate enjoyment. So say I put $10,000 in a fixed deposit for a friend of mine, or some relative of mine, and I can say, hey, this is available for you after it matures in 2 years time. So it's an irrevocable transfer that I have made, but that is something that they cannot enjoy at this point of time, only after 2 years, right? In such cases, it is still a gift, a taxable gift, but it won't get this exclusion, the $14,000 exclusion amount. Uncompleted gifts or gifts of no interest or revocable gifts, basically you have not given any gift over here, and therefore it is not reported on the gift tax return. Now, so we looked at these gift tax exclusions. We said it's $14,000 per person, or $28,000 if gift splitting is made between the spouses. There is an election is made to split the gifts. There are certain other exclusions, which is 100% exclusion. Marital deduction, I'm gifting to my spouse, I get 100% deduction for that. Gifts to minors, my children, for their upkeep of their and actually I should not specifically say gifts to minors, but these are gifts which are general upkeep of the children's life, which is basically paying for their education or clothing or anything. These are 100% excluded. Any gifts that I make to charitable organizations, that doesn't come into here. Any gifts that I make in the form of education or medical fees that I pay on behalf of that person, that is, say I want to pay for the benefit of my friend's education, I can't give her $10,000, but I can pay to her college on her behalf. In that case, it is 100% excluded. Okay, so far we've understood what are gifts, whether it is revocable or irrevocable. When would you claim the exclusion of $14,000 only on present interest and not future interest? And then we also looked at certain gifts which are 100% excluded. Now, how do you compute the tax? You compute the tax on the cumulative gift. And actually, let me just go through this and then I'll come back. So we look at total taxable gifts, right, including the current period. Now, in computing the tax liability, they take your cumulative gifts, that is the gift of the current period and the gift of the prior period, to which they will apply this unified tax rate. Remember, I said what is unified here? Unified means it is the estate and the gift tax rate together. Because again, as I said, they don't want us to give away gifts during a lifetime and escape the estate tax liability. So they unify both of them and they've computed a unified tax rate. To this, you would apply a unified credit. We'll talk about these credits more when we do estate tax return. But unified credit is, again, how does it come? Now, does every person have to pay estate tax? No. There is an upper limit. It's called a lifetime exclusion. For 2017, I believe the lifetime exclusion is around 5. But 2016, it's 5.45 million. 2017, I've written it down in the other slide. I don't remember exactly. But then let's go with the 2016 number as of now. You have a 5.45 million exclusion, which means that you can give away gifts or you can have your estate up to 5.45 million and not be taxed on it. And how is it accounted for, this 5.45 million? Through this unified credit. So if you have a 5.45 million of estate, which means you will get a tax credit of 2.125 million on your tax return. This is a unified credit that is applicable to both the gift and estate. Okay, so as I said, this unified credit will reduce your tentative gift tax. You are also you can also reduce your gift tax by any foreign taxes that you have paid. and reduce it by any prepaid, that is prior gift taxes, to arrive at your gift tax due. Unified credit is an important concept, guys, which I want you to understand. Okay, it is applicable to both gift and estate. So you can have your estate of up to 5.425 million and not pay any taxes on it. How is that accounted for? It is accounted for through this unified credit, where if you have a tax liability, that liability is offset to the extent of 2.125 million. We'll do the example in the book, and this will become very clear actually. So assume that Gates Generous, a single individual, made the following gifts during 2013. Calculate the amount of taxable gifts on his first gift tax return to be filed. Here we are assuming he's divorced during the year and there is no gift splitting with his ex-wife. So he is giving Catty Kindergarten a showpiece valued at $7,000. For Sandra's school, Gates gives the 500 shares in Banana Inc., a public company valued at $50 per share. For Cool College, he's giving a non-interest bearing bond for $40,000, which has a present value of $27,000. For Omi Orphan, he pays $24,000 of tuition fees directly to the school on behalf of Omi. For Sleek Sick, he pays $35,000 in cash to pay for his medical expenses. For Nancy Neese, Gates establishes an irrevocable trust that paid all income to Gates for 10 years, then transferred the trust corpus to Nancy at the end of the year. The value of the corpus was $800,000 when the trust was established, and the present value of the gift was determined to be $350,000. To Fac's father, he sells his condo in Florida for $50,000, whereas its appraised value is $500,000. And then to Mac's mother, he gives $700,000 of cash, and to his wife, he gives $9 million while they were married. So let's see, can he exclude, or how much of it would be taxable income to him, taxable gross gift to him. So to Cathy, he gives a showpiece valued at $7,000. Now, this is something that is available for immediate enjoyment. It's a gift of present interest. Therefore, I would apply the $14,000 exclusion to this and reduce the taxable amount of gift to zero. Now, if I look at Sandra, again, he's giving her shares of Banana Inc., 500 shares worth $50 each, available for immediate enjoyment. So she gets $25,000 value of gift, against which I would apply this $14,000 exclusion, and only $11,000 is taxable gift. Now, for Cool, he is giving these interest-bearing bonds which have a present value of $27,000, but these are bonds that are not available for immediate use, and therefore it is a future interest gift and no exclusion will apply. The full amount will be taxable. Let's look at Omi. For Omi, he is paying the tuition fees directly on her behalf. So anytime you pay an education fees directly, that is 100% excluded from gift, and therefore the entire $24,000 will be excluded. Let's look at Sleek. For Sleek, instead of paying the medical expenses to the hospital, he is giving Sleek $35,000. So that's a gift of present interest, which will be for which you can use the $14,000 exclusion, and then the taxable amount of gift is $21,000. If you look at Nancy, he's establishing an irrevocable trust, the corpus of which will be paid to her after 10 years, which means it's a future interest gift. So $350,000, which is its present value, is fully taxed. Secondly, we're looking at Nancy near. So that was Nancy Denise. Now let's look at the dad. Right, he's selling him a condo in Florida, which was $50,000, but for 50,000, whereas its value was 500. So $450,000 is actually the gift that he is giving him, and this is a present interest gift. So we reduce that by the $14,000 of exclusion to arrive at a taxable gift of $436,000. And finally, the gift that is giving to his wife, Winnie, right, $9 million, that is a marital deduction. You get 100% exclusion on that, right? So none of it is taxable. So if you look at the total gifts that he has given, taxable gifts, it is 1.531 million. Now this is a question that used the 2013 exclusions. So in 2013, your total lifetime exclusion was 5.25 million. So if you look at this, the gifts that he is given is still below that threshold. So therefore, he would still can give away or have estate of 3.719 million in the future without having to pay taxes. Okay, guys, any doubts here? Any doubt here, guys? This, as far as gifts are concerned, their filing, if you look at their filing requirements, they also have a 415 filing like individual tax return and a 6-month extension. It works like individuals. Any doubts here so far? So let me look at the questions here. Okay, let's go to the questions. So, in gifts, as a gist, understand you have to determine, first of all, whether it's taxable or non-taxable. If it is taxable, then you need to determine whether it is present interest or future interest, depending on which you can take the exclusion. And finally, if say you get this in the form of a simulation, you want to check, like how in the existing question, does it meet my lifetime exclusion limit? Is it within that? If it's in excess of that, then obviously it's going to be taxable. So on page number 71, go to question number 23. Steve and Kay Breyer, US citizens, were married for the entire 2016 calendar year. In 2016, Steve gave a $30,000 cash gift to his sister. The Breyers made no other gifts in 2016. They each signed a timely election to treat the $30,000 gift as made one half by each spouse. Disregarding the applicable credit and estate tax consequences, what amount of the 2016 gift is taxable to the Breyers? What would be the answer here?
2,000.
2,000. Okay. Let me go to the. So tell me how you arrived at the $2,000.
They will get a deduction of 28,000.
Yes, and it's 28,000 because
They are electing to that marital deduction.
yeah, they're electing to split the gift, right?
Yeah.
So that's why each spouse gets $14,000 exclusion.
Yeah.
So $28,000 is your exclusion. There's a gift of present interest, obviously, because it's a cash gift, and therefore 2,000 would be taxable. Let's look at the next one. Jan, an unmarried individual, gave the following outright gifts in 2016. She gave Jones, Craig, and Candy. Jones got a down payment on house of $15,000. Craig got a college tuition, and Candy got a vacation trip. What is Jan's exclusions for gift tax purposes? How much can she exclude in total? I saw somebody's hand was raised. It's not there. Deepika, your hand is raised. Okay. I've unmuted you.
I think it will be 33,000.
Yes, yes. And how did you arrive at 33?
14,000 for down payment on house, 14,000 on college tuition, and 5,000 on vacation trip.
Exactly. So the full 5,000 gets excluded, right? So in total, 33,000 is the exclusion. And all of these are present interest gifts, right? And therefore, the exclusion is available. Great, guys. So let's take a mini break now, and join back at around 9:25-ish, between 9:25 and 9:30, and then we'll try to wrap up the rest of the chapter. Okay? Any doubts anybody has? Okay, so I'll just go on the break and then, we'll reconvene again. Okay. Okay, folks, I'm back. Any questions anybody has? Something I have missed? Hey, Nidhi, it's a 10-minute break. I'm back. I'm not sure if you're already here. So one thing, guys, you know, you can unmute yourself that I want to discuss with you is, you know, after we're done with Reg 5, and I'm not sure because the class started late how much we can catch up to Reg 5. But I was thinking that for Reg 6 and 7, being theory topics and, you know, you already have access to the videos, you know, and it's no content change in that, you know, maybe you guys can just refer to the videos for the content, and in the next class, instead of spending time on Reg 6 or Reg 7, I would just take maybe more questions and solve. Like Reg 3, we couldn't complete all the questions, so maybe I can go back to Reg 3 and wrap up those questions, and then the next class would be like the last class. What do you guys think about that option? Reg 1 through 4 is 5 are the more important chapters, and 6 and 7 can be done on your own. You all have access for the videos till the end of the month. I mean, so till the end of the year, actually, till the end of the year, until December, you have access. So, what do you guys think? Any suggestions, any opinions on this?
The videos are sufficient for preparation for 2018 exams?
Yes, yes, yes. So I'm specifically talking only about Reg 6 and 7, which I think, you know, you can do on your own, because it's again theory topic and it's not very interesting to conduct over a webinar, you know, honestly, because there's just a lot of only one-sided talking in there, and you guys can figure it out. What's more important is, you know, these topics where we can have discussions. Anybody has comments on this?
I'm okay if you continue question solving for chapter 3 and 4 or anything.
Yeah, yeah. Okay. Okay. How about others? Would you want a session from 6 and 7?
Yeah.
You want a session? See, 6 and 7, the videos are pretty much self-explanatory, guys.
That should be okay.
That should be okay, right? I mean, these are the important chapters where, you know, we can have our discussions, and I want to actually spend more time on questions in the next class. And, you know, that way it's interactive, and you guys have any doubts, you know, we can close it. Okay. So, I mean, if you have one, yeah.
If you can recap all the 5 chapters, then it's better than rather than only 2. Then recap all the 5 wherein we can get confused in exam. Say you were telling that as you saw in partnership, the basis calculations also. If you can recap all the 5 chapters, that would be great.
That absolutely, that's the plan. We'll do that. Yes.
Yeah, and you can take an extended session also rather than just extend it, say for starting at 7:30, end it at around 11:30 that day. Then
okay.
No issues for others also if it's possible.
Sure, we can give
and
it a
give
try.
1 hour to all the chapters so it gets recap for everybody.
Okay. Okay, I'll try my best to do a recap. So next class will be like a recap class where, you know, you can ask your doubts, and we'll do one chapter recap 1 through 4. 5 is actually like a recap chapter only for that matter, except for a few.
Okay. Solve some simulations because.
Yeah, we'll do that. I'll probably take up one simulation from the. Because simulation takes a long time, so we'll take up 1 or maybe 2. I'll try my best on the OTB, and we'll solve that. Okay. All right. So that's the agenda for the next class. Let me go to this one. So we so far covered all tax returns that are done during the lifetime of the taxpayer. So now the post, right? So let's start with estates. Oh, okay, there's one point that I forgot to add in. Maybe I'll do this when we do estates. Okay. So what is an estate? An estate is something that is created on a death of a person. It's to temporarily hold the assets of the deceased, right? The estates can be created intestate or testate, which means that with will or without will. If it is without will, then the court appoints a trustee who would. It's not a trustee actually for estate. Who's that person? The court appoints an executor. I'm sorry. The court appoints an executor of the estate who would, basically focus on distributing the assets. Now, as soon as a person is dead, there is an estate tax return to be filed, and that is the Form 706. It's a one-time tax return that is filed on the value of the assets in the estate. Now, as I said, we have this lifetime exclusion, and there you can see it is 5.49 million. 425 was what for 2016, and 5.49 million for 2017, and this is also there in the content updates. And the related unified credit is 2.141 million. Okay, so if an individual has an estate that is lower than 5.49 million, obviously does not have to file an estate tax return. But if you have an estate worth so much or more, then you will have to file an estate tax return. And if the executor of the estate takes care of the filing. What consists of your gross estate? It consists of your fair market value of property. It consists of something known as an IRD, which is the income with respect to decedent. Now, we've seen glimpses of this maybe when we did Reg 2 or Reg 1, but IRD, so what is income with respect to decedent? This is basically income that was earned by the decedent prior to death, but it was not distributed to him. So therefore, what happens is it becomes part of his estate. So your gross estate includes the fair market value of property, income with respect to decedent, life insurance benefits. So life insurance proceeds are obviously given to the beneficiary upon the death of the deceased, of the owner, right? So the beneficiary does not have to pay any taxes on the proceeds received, but the owner, the deceased person, has to include this on the estate. Remember, the beneficiary has no tax implications, but the owner who had the incidence of ownership on this life insurance will have to include that in the gross estate. Any incomplete gifts. So remember, when you studied gifts, we said gifts given during the lifetime, we need to file a gift tax return, but there may be some incomplete or revocable gifts. So all of those lumped up and go into the gross estate, and also any revocable transfers that you have done. Now, this gross estate can be reduced by some deductions. These deductions can be discretionary or non-discretionary. Now, what are discretionary deductions? These include a charitable and marital deduction. Now, like how we did in gifts, here too your charitable and marital deductions are 100%. That is, you can take how much ever you want. Your non-discretionary deductions, these include medical expenses that are paid or payable within a year's time, administrative expenses paid or payable within a year's time, funeral costs, certain other liabilities, like for example, say you owed a state tax liability, or you had a mortgage on your house that has not been paid yet. So these are your liabilities, and also state death taxes. So guys, pretty much your estate is like your balance sheet. You know, you have all your assets, you have your liabilities less your equity. So the assets less your liabilities actually form your deductions, which are the discretionary and the non-discretionary. And you know, part of the non-discretionary deductions are your liabilities. Your funeral costs would also be in part of your non-discretionary deductions. Let me show this in the form how it appears, right? And we'd also look at the form 706. So your gross estate less your non-discretionary deductions, which we talked about, then your adjusted gross estate, then your discretionary deductions, then you arrive at your taxable estate. Now, there are also some gifts that, you know, you may make at the time of death, that it could be part of the will as well. So, or gifts that were taxed during the lifetime, right? So all of these are accumulated. Remember, this is a unified credit, right? So you look at your current taxable estate and also the prior gifts that you made and come up with a unified rate. It's not, but remember that this is not subject to double taxation, even though they are calculating a unified rate, because you will see that at the end of the tax return, they will give you a credit for the prior tax payments made. But just to figure out what tax bracket you are in, they will look at your current taxable gifts and also gifts that were taxed during your lifetime. Okay, so the applicable tax rate is computed. I believe the tax rate goes up to a max of about 5 or 40%. Let me just double check that. It goes up to a max of 40%, the tax rate. So once the tax is computed, then to that your unified credit, like the tax credits we have on the individual tax returns, the unified credit is applied. The unified credit depends upon your lifetime exclusion. How much exclusion do you have? Accordingly, you would get your credit. And unified credit is something that you can calculate on your own, guys. And let me show you that, how that's computed. Okay. So this is your unified tax rate table, and you know, you can see it starts as low as 18% and the maximum tax is 40%. Now, how do I calculate what is my unified credit that's available for me? So the maximum limit, let's see, let's do for the 2017 number, and I'm going to do that now. 1 second. Okay, so your lifetime exclusion, that is 5.49 million, right? Okay. Now, so let's see the calculation here. If you look at the column A, it says taxable over 1 million. So let's take the 1 million threshold. So you get 4.49 million. The tax on amount in column A is 345,800. So on 1 million, you have a tax of 345,800. In column B, it says the rate of tax on excess over amount in column A, the tax is 40%. So to this 4.49 million, I apply my 40% tax rate. Okay, so on the 4.49 million, my tax is 1,796,000, and then on the first $1 million, right, my tax was 345,800. So 2,141,800 is your unified credit for 2017. Okay, so which means that if you have a lifetime exclusion of 5.49 million, you can get a unified credit up to 2.141 million. Okay, and that would basically reduce your gross tax liability, estate tax liability. Any questions?
Can you see that Excel again, please?
Okay. So basically, I mean, it's simply a tax computation here. So we're just checking what is our total gross estate. So it's obviously over the 1 million. So we are seeing that for the first 1 million of estate, the tax is 345,800, right? Now for the estate value that is in excess of 1 million, the maximum tax that is there is 40%. So I apply that. So 1796, that is my tax on the 4.49 million. And then obviously I need, and then for the first 1 million is 345,800. So together, my unified credit is 2.141 million. Okay, any doubts? Okay. Going back. So once you apply the credit, then you have the net estate tax liability to which you would reduce by any prior payments. Remember, we took the cumulative gifts, right? So we would reduce by any gift tax payments that you've made previously to arrive at the current estate tax liability. Now, what is the due date of Form 706? It is 9 months after date of death, or plus you get a 6 months extension, for which you generally need to take the permission from the IRS. Okay. Let me show you the form to understand the flow. Close the door, Siddha. Okay, so let's look at the form here. So, of course, there are several sub-schedules to Form 706, and actually, for all practical purposes, doing a 706 is actually probably one of the most difficult tax returns, because it depends on a number of factors. I mean, one thing is because the assets are recorded at its fair market value, so there is a valuation that's involved, and which is a pretty time-consuming process in itself. And then hopefully there are no disputes in the within the the heirs of the estate, so that we clearly know to whom each asset is going to be distributed. So there are a lot of external factors that help that go into actually creating an estate tax return, and each of these assets are actually shown on different schedules. But the first page is like a summary, where you have on line 1 your current period, on your line 2, which is your prior period gifts maybe, and your total taxable. Oh, I'm very sorry, I'm looking at a 709. There you go. Okay. So you have your on line 1, you have your total gross estate, and then your adjusted taxable gifts that you have made on line 4 previously, and then any tentative tax that you may have paid, your total gift tax, to arrive at your the steps that we showed over there as on the slide, that's included in from lines 1 through 8, where you have your total gross estate, your prior gifts, that cumulative gifts that you have made till date, on which you compute, using a unified tax rate, you arrive at your tentative gift tax, and then, to which you would apply your unified credit. Again, these are 2013 numbers, but we're looking at the current numbers, which is 2.141 is what we saw. And then you also get credit for any foreign death taxes that you may have paid. And, and this is possible when, say, the person also had was taxed, maybe it's a dual citizenship and he was taxed in a foreign country as well. Then, he can take credit for the taxes that have already been paid to arrive at your net estate tax. This is generation skipping tax, right? Let's look at that. What does it mean? Okay, so this is applicable when gifts or transfers on death are made to skip persons. And who are skip persons? Basically, they could be your grandchildren or anyone whom, who are at least 2 generations lower than you. So these are skip persons, and generally there wouldn't be a tax liability if, say, the parents died, and therefore you making a gift or a transfer on death to the grandchild. Then the grandchild is not considered a skip person. But if the generation exists, that is, your children exist, but you give to your grandchildren, then that's considered a GST, or a generation skipping transfer, and tax is computed on that. And this gift tax, GST, must be paid in addition to your existing gifts and estate tax. So you would not only be paying a gift tax because you have gifted something to your grandchild, but you will have an additional GST on it. So careful tax planning is required here whenever skip persons are involved. Okay, any doubts, guys? Let's do the questions here. 1 second. Go to the questions. Okay, go to page number 71, and let's do question number 21 and 22, and then the related simulation here. Okay, in computing the taxable, okay, actually 20 and 21 are related, is it? Okay, so let me read the story of 20 and 21. Alan Curtis, a US citizen, died on March 1st, 2013, leaving an adjusted gross estate with a fair market value of $5.4 million at the date of death. Under the terms of Alan's will, $3 million was bequeathed outright to his widow, free of all estate and inheritance taxes. The remainder of Alan's estate was left to his mother. Alan made no taxable gifts during his lifetime. Disregarding the extension of time for filing, within how many months after the date of Alan's death is the federal estate tax return due? When is it due?
9 months.
9 months, yes. Now, in computing the and then let's look at this. In computing the taxable estate, the executor of Alan's estate should claim a marital deduction of, how much is that?
$3 million.
3 million, right? You get a full marital deduction. Whatever you give to your spouse is what you get. Now, under the unified tax rate schedule for 2013, lifetime taxable gifts are taxed on non-cumulative basis, transfers at death are taxed on non-cumulative basis, lifetime taxable gifts and transfers are taxed on cumulative basis, and the gift tax rates are 5% higher than the estate tax rates. What's the answer? What's the answer, guys?
Is it C, lifetime taxable gifts and transfers at death are taxed on a cumulative basis?
Right, exactly. I mean, something that I've been stressing throughout the class, right? Gifts and estate are always taxed on cumulative basis, and we saw on the form as well, especially on the estate tax form. We saw that the gross estate was given, and that to that you add the prior gifts, your cumulative gifts. And likewise, when we did the gift tax return, we saw that we took the gifts of the current period. To that, we also added the gifts of the prior period. Only then we applied the unified rate. Right, so always remember that. Now let's look at this simulation here. So before his death, Remsen, a US citizen, made cash gift of $7,000 each to his 4 sisters. In 2013, Remsen also paid $2,000 in tuition directly to his grandchild's university on the grandchild's behalf. Remsen made no other lifetime transfers. Remsen died on Jan 9, 2013 and was survived by his wife and only child, both of whom were US citizens. The Remsens did not live in a community property state. So at his death, Remsen had a cash of $650,000, marketable securities of $1.9 million, life insurance policy with Remsen's wife named as beneficiary, $2.5 million. Now, for items 1 through 5, identify the federal estate tax treatment for each of these items. So number 1, what is the estate tax treatment of the $7,000 cash gift to each sister? Is it fully, partially, or not included in the estate tax?
Not included in the estate tax.
Yes, and why is that?
Because it's under the $14,000 exclusion limit every year that he gets. So
True. And also specifically on the gross estate, it's not included because it would have been included on the gift tax return, right, which is made during his lifetime. So two answers to this. One, it is under the $14,000 limit, so it's zeroed out, and also it would have been included in the in the lifetime gifts and not here. Now, what is the estate tax treatment of the life insurance proceeds? $2.5 million.
it's included, fully included.
Yeah. Does it matter if the wife has been named the beneficiary?
No, it's included in the gross estate, right? The life insurance proceeds.
Right.
Who the beneficiary is.
Yeah, so see, the thing is, this is very important, guys. I mean, your answer is right, that whatever, I mean, to determine whether an asset has to be included in the gross estate or not, you'll have to see whether the deceased had any incidents of ownership. So if in this case, Remsen had ownership at his death, and therefore, it's included in his gross estate. What is the estate tax treatment of marketable securities? $1.9 million.
They are also fully includable.
Exactly.
In gross estate.
Yes. And the estate tax treatment of the $2,000 tuition fees?
It's not included.
Not included, right? Paid directly to the university. If it was paid to the grandchild, then it may have been included. But then again, the $14,000 exclusion applies. So therefore, it's not part of the gross estate. How about the $650,000 cash?
It's fully includable.
Fully included, right? Just like life insurance proceeds. Great. So that covers our 706. So let's go to Form 1041, which is basically the trust tax return. Okay. So what is the trust basically? We did a brief overview, I think, when we did the introduction class, but trust is something that is set up for the benefit of another person, right? Or some charities. Now, who creates a trust? A truster creates the trust. He's also sometimes called the grantor of the trust. There is a trustee who basically has fiduciary responsibility for the exercise of the trust. You know, he exercises control over the trust, and a lot of times the truster and trustee are the same person. There are obviously beneficiaries. The beneficiaries are those who benefit from the trust. Now, there are two types of beneficiaries. There's an income beneficiary and there is a remainder beneficiary. The income beneficiary receives, the earnings of the trust, the income, whereas the remainder beneficiary receives the principal. Now, let's refer to that page actually, which is on page 28. Which gives us examples of what is income versus what is remainder or corpus. Remainder is also called corpus, guys. Okay, so this page, I think it's page number 38. So corpus of the trust, which belongs to remainder beneficiary, brings in income for the income beneficiary. So what is income? Say, for example, if it is a property that is owned by the trust, then the rent is its income, royalty is its income, mortgage interest payments are its expenses, property taxes, depreciation expenses. So all of this gets allocated to the income beneficiary because it's related to the income. What does the remainder beneficiary get? He gets the property, the purchase or sale, the capital gains and losses, any capital improvements, any mortgage principal payments that you make goes to the remainder beneficiary. Say, for example, we look at bonds. Bonds, what is the income that he gets is the interest income, whether it including municipal bond interest. If you look at the corpus or the remainder beneficiary, they get when the asset is purchased or sold, that's when it affects the remainder beneficiary, and they get capital gains and losses and also any accrued interest on purchase and sale of bonds. If you look at stock, then income beneficiary receives dividend income, and if the remainder beneficiary, he would get the capital gains and losses on sale, or he would also get the stock dividends and splits. So whenever trust documents are formulated, we'll have to see who is the income beneficiary versus who is the remainder beneficiary. We also want to know, the difference between a revocable trust and an irrevocable trust. A revocable trust is generally a grantor trust where the grantor reserves the right to the assets. Therefore, the trust is actually ignored for tax purposes, and the grantor will simply report the related income and expenses on his Form 1040 because he still owns the assets, right? He reserves the right to the assets. So he's just created a grantor trust. Maybe he would make it an irrevocable trust at a later point of time, but as long as it remains revocable, he does not need to file a separate tax return for this trust. Everything goes on his Form 1040. But once an irrevocable trust is created, right, the grantor basically relinquishes all his right to the assets, and then the assets belong to the trust, and then the trust tax returns need to be followed. The trust acts as a separate entity now. Previously, when it was revocable, the grantor and the trust were not separate, they were one. Okay, one more classification which I forgot to include here is the difference between a simple trust and a complex trust, and maybe we'll do that. I'll talk about it orally, but we'll look at the table just in some more time. So I'll just put that down here. So these are some classifications. Actually, it's important from the exam point of view. There are other classifications in the book which I would want you guys to read on your own, but these are some broad classifications that I want you to remember. So what is a simple trust? A simple trust is one which is basically whatever the trust earns is distributed to its beneficiaries. It's simple. The trust keeps nothing. Everything is distributed to the beneficiary except for maybe the corpus, right? The corpus is distributed maybe only when the trust is dissolved, or so the purpose of the trust has been achieved. A complex trust is one where it does not have the attributes of simple trust, where it does not distribute everything to its beneficiary. It may keep some of the income, in which case the trust ends up paying income taxes because it is not distributed. And understand, guys, right? Again, initially when we did the reg introduction, I had mentioned that the trusts also are kind of a pass-through entity. So if the trust distributes everything to its beneficiary, then the benefit, and it will be through the K1, then the beneficiary reports on their individual income tax return. But if the trust retains some of the income, like a complex trust does, then the trust will also have to pay the tax on that income. So it kind of a semi pass-through, right? If the trust distributes, then the beneficiaries pay. If the trust retains, then the trust pays the tax on that. And this is the overview of the trust form, right? A form 1041 is what they file. You have your total income. Total income includes all general income. It could be rents, interest, dividends, capital gains, losses, or any other ordinary income. And there are certain deductions. That is, again, ordinary and necessary to the trust. We'll go through the deductions to arrive at your adjusted total income. Then there is an income distribution deduction. Again, we'll see what that is. It basically, you get a deduction for distributing the income to the beneficiaries. And how is it that determined? We'll talk about it. There are some exemptions, just how at the individual level we have exemptions, depending on the filing status, single or high filing, joint, etc. Here also, depending on the type of trust, whether it is a simple trust or a complex trust or an estate income tax, I'll tell you what that is, you get an exemption. And then you have your taxable income, your tax rate, you arrive at your gross tax liability, reduce for any tax credits such as foreign tax credits, and then you arrive at your net tax liability. So again, total income, I mentioned, it includes interest, dividends, business income. It also includes IRD. So we saw that, I mentioned IRD when we did estate, right? We said it's income with respect to decedent earned by the decedent prior to death, but never distributed. And the interesting thing about this is it is subject to double taxation. So it's not only included on the 706, it's included there as a receivable. Remember, as I said, 706 is your balance sheet, all your assets minus your liabilities. Your IRD was a receivable at your death. So that's why it was included on the form 706 as part of your gross estate. Your 1041 is your income tax return because it's holding that income, right, until it's distributed. So that would also report as income on form 1041. So it is subject to double taxation. Then you have your deductions. As I said, deductions includes interest, taxes, fiduciary fees. This can be deducted. Fiduciary fees is an interesting thing. It can be deducted either on form 706 or on form 1041. And then you also have certain professional fees and charitable contributions. There's one more interesting thing about deductions, which I want to show you a table in the book. I think it may have been part of trusts or part of estates, which you may have missed. Okay. So this table is very important, guys, on page R050. So look at this IRD income. We talked about it, right? It's subject to double taxation. It goes on estates tax return form 706 as an asset, a receivable. It also goes into the income tax return on form 1041. Now, if you look at medical expenses, we said, in 706, it's a deduction. Now, it can go on form 706 or on the final individual income tax return of the deceased person, form 1040. Administrative expenses. Administrative expenses can be taken on form 706 or it can be taken on form 1041. So again, these are expenses that are paid or payable within a year's time. Okay, so you have the discretion of including it either on 706 or 1041, but not on both. So, so these are all your deductions. You'll have to be careful in terms of, what the question is saying, especially where there is dual deductions, possibility if for professional fees or administrative fees or medical expenses. And of course, IRD must go in both places. What is your adjusted taxable income? It is your total income less your deductions. Now, I said, the trust also gets an income distribution deduction, and that is basically for distributions made to the beneficiaries. Now, before calculating, what is your deduction, you need to figure out what is your distributable net income. So what is distributable net income is an important concept. Basically, this is the amount that is available for distribution to the beneficiaries. Okay, so it helps in arriving at the distribution deduction. And how do you calculate DNI? It's the total income less deductions, because deductions are obviously amounts that have been spent, not available for distributions, less capital gains. Why are we subtracting capital gains? Capital gains is part of the corpus, right? It's not available for distribution. Less your, it should be add tax exempt income, not less. Plus your tax exempt income. Now, a tax exempt income, even though it is tax exempt, it is available for distribution, right? And therefore, that has to be added back in arriving at your distributable net income. Guys, DNI is a very important concept, and I want you to understand this well. I'm just repeating it again. DNI helps in determining the IDD, which is the income distribution deduction, right? So what is DNI? It is the total amount of income that is available for distribution. So when we determine what is available for distribution, you start with your adjusted taxable income, right? That is your starting point, and or you start with your total income. You can either start at adjusted taxable income or total income, because your adjusted taxable income is your total income less deductions, this part, right? This is the same as this. So say you start with your adjusted taxable income. To that you reduce your capital gains, because that is not subject to distribution. It is part of the corpus. And to that you add your tax exempt income, because even though it is not taxable, it is available for distribution. Okay, so now once you've computed your DNI, then you figure out what your IDD is, your income distribution deduction. And how is that calculated? This deduction is allowed for distribution of income to beneficiaries, which are taxed on the beneficiary's income tax return. It is computed as a lesser of your DNI less tax exempt income, or actual distribution less tax exempt income. So you take the lesser of these two, your DNI or actual distribution. From both of these, we subtract tax exempt income again. Why? Because tax exempt income was never taxable, right? So then why would we get a deduction for that? So that's why we subtract the tax exempt income. It's only added back to arrive to figure out what is distributable, but is never actually a deduction. Guys, anybody has a doubt in the treatment of tax exempt income? So again, as I said, right, tax exempt income, it's only added back to figure out what is distributable. But when you're calculating your IDD, you subtract the tax exempt income portion of it. If the entity had no tax exempt income, it's simply the lower of the DNI or the actual distribution. So that would go as your IDD, and it would reduce your adjusted taxable income. Then you also have exemptions, and I said it depends on the type of trust, simple or complex trust. A simple trust has a deduction of $300. A complex trust has a deduction of $100, and then there is an estate income tax return where the exemption is $600. And this is where I was going to tell you. So we filed Form 706. It's an estate tax return, a one-time tax return that is filed on the death of the particular person. We file a Form 1041, which is for a trust. Basically, a trust is a vehicle that holds certain assets for the benefit of somebody, or for a charity, or until a purpose has been achieved. Now, an estate income tax return is actually more of a, and the trust could go on for a long period of time, depending on the life of the trust. Now, an estate income tax return generally has a shorter life. See, all the assets that are there in the estate, as long as they are generating income, you will need to file an estate income tax return. Once the assets in the estate is distributed, then the estate income tax return is no longer required. So, like for example, let me say, say Mr. X owns an apartment building and a restaurant in an estate, right? So now this has been valued. The estate taxes have been filed. Now, the distributions, so they have, and also assume that they have two children, to whom one of whom is going to get the restaurant and the other is going to get the apartment building. Now, until the formalities, legal formalities or whatever are settled, which may take a longer period of time, maybe a year or so, these assets will continue to generate income, right? Now, we file the estate tax return based on the value of the estate, but what about the income that is being generated by the apartment building or the restaurant? Who is going to file taxes for it? It is not yet being distributed, but then it is parked in the estate, right? So as long as it is parked in the estate, an estate income tax return needs to be filed, and that is what is this, and it's filed on a form 1041. Once these assets have been distributed, then an estate income tax return is not required. Okay, guys, the differences between an estate and an estate income tax return and a normal trust that is filed every year. Okay. So once you apply these exemptions, then you calculate the tax rate, which is very high, 0 to 39.6%. And then some tax credits are applicable. These could be foreign tax credits or any business credits. And then you arrive at your taxable or gross tax liability. Now, let's see if we have a form 1041 in our book. Do we? Okay, we do have the form 1041. Let me just show that to you. Okay, so form 1041, your estate tax return. So you can see a total income consisting of interest, dividends, and business income, and all the various types. Then you have your deductions. Your deductions include your fiduciary fees, charitable deduction. If you were a complex trust, you would get a charitable deduction. If you were a simple trust, you would not get it. So that's your fiduciary fees. Again, if you didn't take on form 706, then you would take it here on form 1041. So you arrive at your adjusted total income, to which you would arrive calculate your IDD and put that here, your exemption, your total income, taxable income, and then your total tax. The calculation of IDD is computed on the second page, where we start at adjusted total income, which is basically a total income less deductions. To that, you add your tax-exempt interest. You subtract any capital gains because it's not available for distribution, and then you arrive at your DNI. Now, again, you do a DNI less tax-exempt income, or you do your actual distributions less tax-exempt income. You take the smaller of these two, and that becomes your IDD, which goes on the first page of form 1041. If you're making any distributions to the beneficiary, then those distributions will be reflected via the Schedule K1. Okay. Okay, again, differences between simple and complex trust, as I said mentioned. A simple trust, your annual distribution is equal to your distributable net income. You don't get any charity. Income distribution deduction is generally equal to taxable income, reducing the taxable income to 0, right? And why would taxable income be 0? Because the simple trust is pretty much distributing whatever it earns to the beneficiary, and therefore the beneficiary is going to pay taxes on his individual tax return. Because the distribution, as whatever is reported in his K1, would go on his tax return. And whereas a complex trust would not, include this as part of their basically a complex trust would file a tax return because it's not distributing all of its income. Something that I don't have in the slide here. Filing requirements of Form 1041. Generally, they need to file by April 15th, plus they get a 5.5-month extension. They all are on calendar year basis. They must file on calendar year basis. Estates, though, can be on fiscal year because it depends upon the death of a person, right? So that kind of wraps up your trusts. Any doubts here before I move on to questions? Okay, so let me go to the questions here. Okay, question number 15 and 16. Line, a cash basis taxpayer, died on Jan 15, 2013. In 2013, the estate executor made the required periodic distribution of 9,000 from the estate income to Line's sole heir. The following pertains to the estate's income and disbursements in 2013. $20,000 is the taxable interest. $10,000 is the net long-term capital gain allocable to corpus. The disbursements are $5,000 towards administrative expenses. For 2013 calendar year, what is the estate's DNI? So we just looked at what DNI is, right? So help me here, guys. Question number 15. They want us to know what is the estate's DNI. So how is DNI computed? It is your total income less deductions less capital gain income, because that belongs to corpus, and tax exempt income, right? So what do we have here? What all do I need to add to arrive at DNI? Who's going to help me? Guys, you're able to hear me, right? So let's, somebody be a volunteer. Manoj, I'm unmuted. Somebody is making a lot of noise. Manoj and Meenakshi are unmuted.
कोई बात नहीं.
Manoj and Meenakshi, you want to give me the answer? Okay, let's look at this, right? We have taxable interest. This is $20,000, right? Now, to that, should I add the long-term capital gain? I don't need to, right? Because that's part of the corpus. It's not distributable, right? But can I subtract my administrative expenses?
Yes.
I can, right? because it's not available for distribution. So I can say the DNI is basically $15,000. Yeah. Now, if we take this question further, and they're asking you what is the IDD, how do we do that? IDD, income distribution deduction, that is the lower of DNI or actual distribution, right? What's the actual distribution? That is $9,000, right? So my IDD would be the lower of DNI, which is 15K or 9,000. That would be my IDD, right? Okay. So, I mean, this is what you would look at, guys. DNI calculation is important for, trusts. Now, let's go to the next question. Lions Executive does not intend to file an extension request for the estate fiduciary income tax return. By what date must the executive file the Form 1041 U.S. Federal Fiduciary Income Tax Return for the estate's 2013 calendar year? So we just looked at the due dates, right? For trusts, it's basically always calendar year. So if it's a calendar year, then what is the due date?
9 months, September 15th.
April 15th. 9 months is for the 706.
Okay.
But yeah, so this is the estate income tax return, which is basically a Form 1041. This is the same as the individual deadline, 415. Again, this is a question that may not be any more relevant because AICPA specifically said that they're not going to test the due dates. Next, the 2013 standard deduction for a trust or an estate in the fiduciary income tax return is. What is it? It's actually zero, right? Because fiduciary income tax returns have exemptions. We talked about 300 for simple, 100 for complex, and 600 for estate. So they don't have a standard deduction for trusts. Trusts have exemptions. Okay. Now, which one of the following is a valid deduction for a decedent's gross estate? Foreign death taxes, income tax paid on income earned and received after the death. C, federal estate taxes. D, unpaid income tax on income received by the decedent before death. What would go in here?
Is it A, foreign death taxes?
No, because death tax is a credit, right? Remember, it's a foreign tax credit that we get. It's not a deduction. It reduces the tax liability, but it's not a deduction per se.
Okay.
So from the gross estate, what would you deduct? Remember, I'll give you a clue, right? I said it's like a balance sheet, assets less liability. From your assets, your liabilities are your deduction to arrive at your assets are your gross estate. From that, you would reduce your liabilities to arrive at the taxable estate. So then what would be your answer? Which one?
D.
D? Yes, yes. Why is it D?
It's unpaid income taxes on income received by the decedent before death. It is a liability.
Exactly, absolutely right. So it's a liability, right? Unpaid income tax on income received by the decedent before death. So this is a liability that the estate has to pay, and therefore that reduces the gross estate. Now, income tax paid and income on income earned and received after the decedent's death. So this is IRD, right? But the income tax has been paid. So most likely it will reduce your tax payment. It is calculated like a credit which reduces your tax liability, but it's not a deduction. Federal estate taxes, obviously you don't get a deduction for the estate taxes that you pay. So that's not the correct answer. And so let's look at 19. Ross, the calendar year cash basis taxpayer who died in June 2013, was entitled to receive a $10,000 accounting fee that had not been collected before the date of death. The executor of Ross's estate collected the full $10,000 in July 2013. This $10,000 should appear in only the decedent's final individual income tax return, B, only the estate's fiduciary income tax return, C, only the estate's tax return, D, both the fiduciary income tax return and the estate tax return.
I think it's D, both the fiduciary income tax return and the estate tax return.
Yes, and that is because what type of income is this?
Because it is income earned before the death.
So it's called IRD, right? Received, earned before the death, but received only after the death. So income with respect to decedent. Great. So let's look at the last topic now. Let me go to this one. Finally, we have exempt entities. Tax exempt organizations. Okay. So by the word tax exempt, we understand that these entities do not have to pay any form of tax, right? But they do have some reporting compliances. And what are these tax exempt entities? These are basically IRC section 501 entities. There's also a 501c category, which are basically entities to whom you make charitable donations, and those donations are deducted on your tax return, whether it is individuals or corporate entities. But the broader category is section 501 category, where they're all tax exempt, and these could include charitable organizations, it could include educational institutions, religious organizations, some social clubs, credit unions. These all fall under tax exempt organizations. Now, how do you get your tax exempt status? You actually have to apply for it, and you have to continue to be a tax exempt entity. That is, your activities cannot be outside of your tax exempt nature. If it is, then you lose your special status. Now, it does not include any political organizations or feeder organizations. Feeder organizations are basically those who who earn through non-exempt means, but then donate everything to charity, and then they try to choose the tax exempt status. Then that is basically not allowed, and you lose your tax exempt status. What are the tax returns that they file? They file a form 990. Again, all of these are information returns. 990 PF, this is for private foundations, and then there's a 990N, which is called like a postcard return, because there's hardly anything that goes on it. And it is filed by organizations whose gross receipts are $50,000 or less. Now, sometimes these exempt organizations will have unrelated business income, again, basically not related to the exempt nature, in which cases they may have to file a tax return and pay taxes. Because they are filing a tax return, but they will have to file this form 990T and pay taxes. Now, what kind of tax they will pay depends upon the type of entity. If it's a corporate entity, it will file a corporate tax rate. If it is a trust, then it has a trust tax rate that it will file. Now, there are certain items, though, are unrelated to the exempt nature, can still be okay, which means that they don't trigger the UBI tax. This is, for example, any bingo games that are played in the churches, any annual charity auctions, or any sale of material for the benefit of the members of the organizations, or say any activities that are staff by volunteers. These are all those slightly they are unrelated from the exempt nature. They are okay. They're okay for these tax exempt organizations and do not trigger UBI. But anything else would trigger UBI and they will have to pay taxes. And this will be on income in excess of $1,000. Okay, guys? I mean, tax exempt is pretty fair and simple and straightforward. I'll just do a few questions here. Okay, so question number 25, which of the following exempt organizations will be eligible to satisfy its annual filing requirement by Form 990N? Church, private foundation, an exempt organization with $20,000 of gross receipts, an exempt organization with $3,500 of gross income from an unrelated business. Who would file a 990N? C, right? Less than $50,000 of gross receipts, yes. Now, 26, HOPE is a tax-exempt religious organization. Which of the following activities are consistent with HOPE's tax-exempt status? Conducting weekend retreat for business organizations, providing traditional burial services that maintain the religious beliefs of its members. Which is consistent with the tax-exempt status?
B.
B, right? Two only. One is more like a resort activity, right? Conducting weekend retreats. That's not a part of the religious organization's nature, but definitely number 2. Which of the following activities regularly conducted by a tax-exempt organization will result in UBI? Selling articles made by handicapped person as part of their rehabilitation when the organization is involved exclusively in their rehabilitation. 2, operating a grocery store almost fully staffed by emotionally handicapped persons as part of a therapeutic program. Which of these will result in UBI?
Neither D. One nor 2.
D, exactly. D, you're right. Both of you are right, right? Both of them the activities are part of the tax exempt nature. It's not UBI. Now, if an exempt organization is a charitable trust, then UBI is not subject to tax, taxed at rates applicable to corporations, subject to tax even if such income is less than $1,000, subject to tax only if the amount of such income exceeds $1,000.
D.
D, excess, right? The tax, it's not necessarily, a trust would be taxed at the trust tax rate and not the corporate tax rate, and it's subject to tax only if the income exceeds $1,000. Now, which of the following activities regularly carried out by the exempt organization will not result in UBI? The sale of laundry services by an exempt hospital to other hospitals, the sale of heavy-duty appliances to senior citizens by an exempt senior citizen center, C, accounting and tax services performed by a local chapter of a labor union for its members, D, the sale by a trade association of publications used as course materials for the association's seminars that are oriented towards its members. So D here is the correct answer, because if you see, it's a trade association, it's selling its own publications, its course material, which is intended for the benefit of its members. So it's not stepping out of its exempt purpose. But if you look at the other options, like for example, the sale of laundry service by exempt hospital to other hospital. Now, a hospital, its primary purpose is not laundry services, right? This is more of an unrelated business income. The sale of heavy-duty appliance to senior citizen by exempt senior citizen center. The purpose of a senior citizen is more of hospice, right? Home care. It's not the selling of appliances. So this is UBI again. Accounting and tax for service performed by a local chapter of a labor union for its members. Again, labor union's purpose is not to provide these ancillary services. This is extra in addition to their exempt activities. So again, this is UBI, except for D. Okay, guys. Next, if an exempt organization is a corporation, the tax on unrelated business income is computed at corporate tax rates, computed at rates applicable to trusts, credited against the tax on recognized capital gains, or abated.
Yeah.
Yes, that's fair and simple. Yeah. So guys, this covers, even though I thought I was ambitious about doing Reg 5 today, couldn't do it, but I think it'll be a good thing to defer to the next class, because Reg 5, the first few pages are a recap of what we've done from Reg 1 through Reg 4. So as part of that recap, we can solve questions and cover the first few pages of Reg 5, and we can wrap up Reg 5 in the next class. Okay. Any doubts you guys have? And one more thing before you guys start. Yes, the last class we had a little bit of doubt on the medical expense deduction. Should we take 7.5% or should we take 10%? What should we stick to? So I did some research on that during the week and figured that we should actually use the 10% rate. I'm sorry, the 7.5% rate. 10% was applicable until 2016, and starting 2017 they have reverted it to 7.5%, and that is going to be tested from Q3 onwards. So the medical expense deduction for individuals, the threshold is 7.5%. Now the question that comes here is, okay, now that regular tax has become 7.5%, do we need to compute the AMT difference, because AMT is at the 10% rate? So the IRS has specifically said here that because this shift from 10 to 7.5 is only a temporary shift, they're going to ignore this AMT difference for that short period of time. I think only for a couple of years they are doing this 7.5% shift. So they want you to ignore the AMT difference that's arising because of the 7.5 versus the 10%. So the only change you need to remember is that for regular purposes, it's moved to 7.5%. Okay. Any questions that you guys have? So the good news is the webinar has been recorded, but I don't know when it actually started recording because we had those initial technical errors. It's recorded, so whatever we get is good. Any doubts, guys? Anything that you want to ask me? Okay, so then we'll do a wrap up and I'll see you guys in the next class. All right? Bye-bye.
Thank you, ma'am.
Thank you.
Thank you. Bye-bye.
Bye.
Bye.